Let's start with a chart that Wall Street is desperately hopes you ignore. This is not a sentiment. This is not a vibe check. This is not a short-term trading signal. This is math. What you're looking is you're looking at the S&P 500 PE ratio plotted against a subsequent 10-year annualized return. That is what you're looking at. And the message of this chart is brutal. The higher you pay today, the less you earn tomorrow. No narratives, no Fed spin, no hype, no AI hype, none of that. As you could see, as you go forward through time, the higher the PE, as you could see, the lower the valuation. The forward PE and the amount of return. The more the PE, the lower the return. The more you're willing to pay for it, the lower the return. So on the horizontal axis, this is very good. We have the forward price. We have the forward price to earning ratio, which is how much money investors are willing to pay for each dollar of earning from a particular company. What investors are willing to pay for expected earnings at a given moment in history. And on the vertical axis, we have what investors actually earned over the next 10 years, annualized. So each dot represents a historical starting point. And notice the pattern. As valuation rises, meaning as the more you pay for it, PE ratio of 0 to, a lot, in this case up to 24, 25, that's an average, obviously. Keep in mind that, for example, Tesla is 150 for PE. Anyway, notice the pattern. As valuations rise, returns collapse. This is not subtle. This is not debatable. The regression line slopes decisively downward. This means nearly 3/4 of long-term return outcomes are explained by starting valuation alone. Not earning surprises, not innovation cycles, no central bank errors, valuation. The further you go to the right, which means the more you're willing to pay in terms of a PE, the lower the amount of return over 10 years, as you could see on the left. This thing is hedging towards bottom right. This matters because forward PE already assumes earning growth, margin stability, optimistic forecast. In other words, this chart is already generous. And even with that generosity, the outcome is clear. When investors paid 12 to 14 times forward earnings, 10-year returns clustered around 12 to 18% annually. When they paid more, which means 16 to 18 times forward earnings, return fell by 6 to 10%. And when investors paid 20 to 24 forward earnings, return approached 0. And in some cases, negatives. So that's not a crash. That's worth. That's a lost decade because it's a 10-year. It's a 10-year forward earnings. So where are we today? Well, that's where the part nobody wants you to talk about. Look at the far right of the chart. That's us. Look at all the way to the right. At the bottom, you see that? Estimated earning P ratio for December 2025. That's us. That's where we are. So this places us in the historical danger zone. Based on this relationship, expected 10-year returns fall somewhere between 0 and 3% annually, before inflation, before taxes, before volatility. This is not bearish ideology. This is arithmetic. You can debate timing. You cannot debate valuation math. Now, let's address the usual pushback. Yeah, but this time is different. It's never different. Rates were lower. Rates were also low in the late 60s. Returns were awful. Technology changes everything. Well, so it did in 2000. AI justifies higher multiples. Well, AI does not repeal cash flow discounting. Every generation invents a story to justify paying too much. We are on our way for something. When it's going to hit, that is going to be the question. Every generation learns the same lesson. Valuation don't determine when markets fall. They determine how much return you give up while you're waiting. That's the trap. This is not a collapse. This is underperformance. This chart exposes the real danger facing investors today. Not a crash headline, not a panic sell-off, but a decade where stocks go sideways, volatility increases, real returns evaporate, and investors stay fully invested because nothing seems wrong. That is how capital quietly destroyed. That is how it gets destroyed. Not violently, gradually. You're looking for the crash. No. And here's a takeaway. High valuation don't tell you what to sell. They don't tell you when to sell. They tell you what not to expect. And right now, the market is priced for perfection, stability, and permanent optimism. History says that price leads to disappointment. Every time. The question isn't whether this chart is right. The question is whether investors are willing to accept what it's telling them. Because valuation always wins. Not today, not tomorrow, but over the long horizon, that actually matters. So keep that in mind while you're looking at this chart, looking how much people are willing to pay, investors are willing to pay for stocks. And as you could see, the higher they pay on the right, the lower the returns on the left. Which means for you to make money, what you need to do, you need to be on the left side. You need to invest in low PE stocks, but not the Walmart of today. You want to invest in the Tesla or the Nvidia of tomorrow while the PE ratio is still low. And that is the secret. Here's another one for you. Let's take a look at this chart very carefully. This is not just growth versus value. This chart is a structural warning about how distorted the U.S. equity market has become and what it means for investors going forward. When you are looking at is the S&P 500 growth versus the S&P 500 values, expressed as a percentage of the total S&P stock price index, going all the way to 1990. So blue is growth, red is value. And the horizontal line is a 50% represents the balance. And right now, growth is sitting at roughly 73% of the entire S&P 500, while value has collapsed at just 30%. That's not normal. That's not healthy, right? And historically, it never ends quietly. So let's start with the big picture. for most of the modern market history. Growth and value believe it or not, oscillate around parity. Sometimes growth leads, sometimes value leads, but they revert toward balance, right? Markets like symmetry. Look at the chart. Look at the old chart. At one point, there was symmetry, right? If you look at the chart itself, this is from 2026, right? So basically, when you were in 2008, 2000, right, there was symmetry here going on. But not any longer. Why? That symmetry is lost. What does it mean? Well, sometimes growth leads, sometimes value leads, but they revert toward balance. When one style becomes too dominant, it carries the seeds of its own reversal. And every single time growth has pushed this far ahead, every time it has been followed by painful underperformance. Go back to the 90s. Look at it. Go back to the 90s. Look at that spike in blue. Okay? That was the dot-com era, when investors convinced themselves valuation no longer mattered. Growth exploded, value collapsed. Old economy companies were treated like relics. And what happens next? Well, the NASDAQ crashed nearly 80%. Growth imploded. Value survived. Right? And then outperformed for nearly a decade. This chart didn't just flash a warning back then. It screamed, look at it. It's talking to you. It is screamed. Fast forward to today. We are now well beyond, that dot-com extreme. Growth doesn't just dominate. It completely controlled the index. Look at the blue line to the right. The S&P is no longer a diversified market benchmark. It's not. It is concentrated growth trade masquerading as diversification. A handful of mega cap tech and AI linked stocks now dictate index returns, volatility, and risk. This is not capitalism allocating capital efficiently. This is crowded positioning amplified by passive flows. Let's talk about what changed structurally. First, ultra-low interest rates. For more than a decade, the Federal Reserve trained investors to believe that duration is free. Future earnings were discounted at near zero rate, which massively inflated the valuation of growth assets. When rates are artificially suppressed, long-duration assets, growth stock, look irresistible. A value which depends on current cash flows gets ignored. Second, passive investing. ETF don't ask questions. They don't evaluate valuation. They buy whatever has the largest market cap. So when growth starts outperforming, it attracts more passive inflows, which pushes price higher, which increases index weight, which attracts even more capital. That is not price discovery. That is momentum compounding. Third, narrative dominance. AI, cloud, platforms, winner takes all. These narratives convince investors that scale alone guarantees future profits, regardless of the price. And then narratives dominate fundamentals. Valuation stops acting as a constraint until suddenly it does. Now, here's the most important part. This chart is not saying growth stocks will disappear. It is saying expectations have become mathematically unsustainable. When growth is already 73% of the index, there are now two ways around. Either growth continues to absorb an even larger share of the total market value, which would imply absurd concentration, or returns compresses. Historically, it always the second option. Let's bring in the macro overlay. Interest rates are no longer zero. Liquidity is no longer unlimited. Fiscal dominance is crowding out capital, private capital. So long duration assets are no longer being subsidized by policy. That changes the discount rate regime. And when discount rates rise, even modestly, growth evaluation are hit first and the hardest. Value doesn't need perfection, growth does. Look at the shaded recession band on this chart. Every time the economy slows, growth dominant gets tested. Why? Because in downturns, investors rediscover cash flow, balance sheet, and pricing power. They stop paying attention for stories and start paying for survival. That is when value quietly regains relevance. Now, zooming in the last 5 years, even though inflation, rate hikes, banking stress, and growth dominant kept expanding, that tells you something critical. This isn't confidence. This is dependence. The entire market has become dependent on a narrow slice of growth stocks to keep indices afloat, those Magnificent Seven. This is not resilience, it's fragility. Here is the uncomfortable truth. When growth eventually corrects, it doesn't need a crash. It only needs time. Fiat returns combined with inflation quietly destroys purchasing power. Meanwhile, value doesn't need heroics. It just needs normalization. Reversions don't announce themselves. They grind. So what does this mean for investors? It means diversification based on tickers is meaningless if exposures are identical. Owning 5 S&P ETF is not diversification. If they are all loaded with the same growth risk, it means the next decade is unlikely to look like the last one. And it means the biggest mistake investor can make is assuming that we worked during the era of zero rates will continue to work in a world of structural constraint. This chart is not calling a top tomorrow. It's calling out imbalance. Markets don't break because of bad news. They break because of crowding. And right now, growth is not crowded. It is dominated to an extreme never sustained in history. So the takeaway is simple, right? When one style becomes this large, future returns are mathematically pulled forward. What feels safe becomes risky. What feels boring becomes valuable again. And history suggests that when growth commands this much of the market, the next chapter is not acceleration, it's adjustment. So if you understand this chart, you understand why forward returns matter more than backward narratives. This is not about timing. Again, it's about recognizing that imbalances always resolve. And when they do, they rarely reward the most crowded trade. Look at the blue line. Next, take a look at this chart. Take a look at this chart. What does this tell you? Let me tell you. This is not just another valuation chart. This is a 30-plus year record of capital misallocation. A slow motion distortion on how markets price risk, growth, and reality itself. What you're seeing there is a price to book ratio. Okay, of value stocks relative to growth stocks inside the Russell 1000. Small caps. And the message is brutal. Value has been systematically repriced lower for more than 2 decades, not because fundamentals collapsed,